So now we're seeing a pickup in the 10, 196.84 versus about 196.5 just ahead of those comments. Sri?
Yeah, not much in terms of the specifics in terms of whether she supports 50 basis points in March or supports Bullard's 100 basis points in total over the next 3 months. But clearly the emphasis here is that inflation has not peaked yet and the Fed need to move more faster in normalization. Let's bring in Robert Luna now, CEO and Chief Investment Strategist at Surevest. CI Financial Company. CI manages $264 billion in client assets as of November the 30th last year. Joins us from Newport Beach, California. Robert, thanks for your time. When you look at the balance of risks from Putin to Powell, do we need to raise cash?
Yeah, I mean, look, geopolitical risks that we're seeing out of Russia are nothing new. And these usually are temporary moves in the market, people, changing trading positions and so forth. Obviously, the bigger issue in terms of how you want to position your portfolio should you be raising cash is what's going on with the Fed. And you alluded, are we going to have a 50 basis point hike? Are we going to see something closer to 100? I think 50 is baked into the market right now. And, the challenge always is with trying to predict these things is if you look at the market as a whole, it really hasn't sold off too much. The S&P's been kind of hanging in there, down 78% with all this turmoil going on. But there's a tremendous amount of carnage if you look at some of the areas that are right in the eye of the storm, if you will, technology stocks that are down 40, 50%. I think the vast majority, if you look at Cathie Wood's ARC portfolio, is trading down right in that 40 to 50% range. So there's already been a lot of damage done. So if you're raising cash, it's probably not going to be in those areas. Maybe some of the safe havens that have held up well. We'll see what happens to those as interest rates start to rise.
And Rob, do we continue to buy the price makers in this inflationary environment?
Yeah, I think so. Some of the dividend growth stocks, if you're looking for an index, which would be the dividend aristocrats, for example, have held up tremendously well, almost flat on the year. I think money in the near term will continue to go there. That being said, as I mentioned, it's been going there for a while, so valuations there are actually getting stretched, and you compare those to some of these technology names, in many cases are more expensive. So, if you haven't sold the technology names yet, probably not, the time to do it. If you are raising cash, I would look at some of those names that are actually up on the year, trading above their 5-year valuation. That's probably a good place to start trimming your portfolio.
Rob, Martin here. Let me quickly jump in. Let's take a step back because I know that's what you like to do. You're advising investors to take a longer-term view, 12 to 24 months as opposed to just 12 to 24 hours. Let me stretch that a little bit, though, say 36, 72 hours out. I mean, this is going to be a pretty hairy weekend, is it not? Markets close Monday for President's Day, right? You've got Russia, Ukraine threatening to blow up. If it does, I got to wonder, I think I'm not the only one out there thinking this, if this market has another real leg down to finish this purge out, to get to the bottom, if conflict erupts over the weekend, that could be the trigger, don't you think?
Yeah, I mean, it definitely could be. I mean, we haven't really even gone back and tested, which is another 4 or 5%, those January lows, right? So that could definitely happen easily. And, Russia could be the quick trigger to do that. As I mentioned, though, I don't think that's the longer term thesis. If you're looking to sell now, I wouldn't be selling those technology names that have gotten beaten up so bad. That being said, if you are lucky enough to be sitting on some cash right now, and I think a lot of investors are, I don't think there's any reason you have to rush into the market until we get a little bit more clarity out of the Fed, and obviously we get some pressure off of the Russia situation.
Rob, do you like Walmart and do you like the consumer staples broadly? When you look at the reaction to the earnings, it suggests that the market continues to move towards those companies and favor those companies that have pricing power.
Yeah, I do like Walmart. We own that in our dividend growth portfolio. A lot of those names, Chevron, Pepsi, Procter & Gamble, Kimberly-Clark, that's where everybody wants to be right now. We've been there, we've been positioned there, and that's why, actually asset allocation is really working right now. You don't want to be all in an ARC portfolio this year. You obviously did for the last couple of years, but times like this are really what show the validity of asset allocation. And if you've been diversified, maybe you're down 3-4%, but if you've been in the eye of the storm, if you will, you've seen your portfolio cut by a third.
Rob, I got to ask you, after the session we had that just was, right? Dow down 600 points, down almost 2%. S&P off more than 2%. NASDAQ closer to 3% down. You're sticking with the strategy of buying the dip. I'm wondering how many people are going to be along for that ride, because I mean they don't seem to be emerging now. And with that Russia risk, let's say they do buy the dip, they could end up trying to catch a falling knife.
Well, here's one thing I can tell you, Martin. I've been doing this for 25 years, so I've seen a lot of things happen during that time, starting with the tech meltdown in the late 90s. And, every single time that we've had these types of crises, no one's ever rang a bell and said, now's the time to buy. As a matter of fact, if you look at the bottom of March of 2009, it was absolutely the worst time to buy. The S&P was at 666 at that bottom. We're now above 4,000. So for long-term investors, and this is why we always talk to our clients, our investors, about positioning, timeframes. If you need money in the next year, probably should not be in the stock market at all. Next 2 to 3 years, that's where you have those dividend growth names. But your 3-year plus time horizon, those big growth names, innovative companies like Airbnb, Roblox, those names that are going to get beat up right now, but are down 40 to 50%, it's probably time to start dollar cost averaging in those, because by the time you feel good about it, by the time the news is clear, the moves have already been made to the upside.
Wow, buy on the way down. Okay.
Rob, how do you approach the markets outside the US? And if the clear and present danger is in Europe with a conflict brewing on the front doorstep, how do you approach that region? And how would you approach Asia and China?
We typically tend to be bottoms-up investors, so we're not necessarily geographically looking at where should we position assets. That being said, a lot of the international markets, Asia, Europe, didn't perform nearly as well as the U.S. So some of those names, if you actually look at emerging markets like China, because they got sold off so hard last year, have held up a lot better. So I would say to investors, if part of your asset allocation is to have 5 to 10% in China, in emerging markets, and you've been significantly underweight, this is probably a time to get back to that normal asset allocation model that you have for your long-term strategy.
Okay, noted. We'll pencil that in. Rob, great to talk to you. Great value as always. Thank you. Appreciate it. You keep safe, and we'll do it again very soon, I hope. Rob Luna there, Surevest, a CI financial company.